Okay, welcome to another episode of Ridiculous. So, yesterday we put aside the Algoma Central research. Decided that just wasn't the right company or the right time, and so we're back to the screen. So we're gonna run a screen here and see what companies get pulled up. And we run very basic screens. So usually it's market size and market cap size, a basic financial metric, and that's it. And then you're just trying to, and also usually typically we're only looking for North American listed stocks. So if there's any North American, any international stocks outside of North America, we're really not looking at seriously. Both from the ease of trading and also just understanding. Great companies outside of North America, fantastic companies. But again, you got to be able to figure out if they're the right ones to buy or not. So, in general, we stick to North America. There's lots of companies there, right? You don't have to make money everywhere or on everything. Just need a couple good businesses that you can buy, keep in the bank, and let them do the work for you. Okay. So let's see what we can see. So there's over 900 matches, which means there's a lot of reading to do. All right, let's just set this up here. We usually don't care about certain things. Yeah, all the technical factor mumbo jumbo, we just kind of ignore it. We don't know about that. We're really just trying to find good businesses where we can compound money at greater than 10%. And if we can do that, you know what? We're doing all right. If you do the math, the and whatever net amount of money you're starting with now, if you just do the math, simple 10% a year, which is in a 5% world, it's still good. Simple 10% a year is gonna, given a long enough timeline, you're fine. Right? You don't necessarily need to shoot the lights out. You will be all right. Okay. Question is, do we start from the top or do we start from the bottom? Let's start from the small stuff. Let's start from the small stuff. Okay. Mastermind. What is Mastermind? Marketing agency. Okay. So we're fine looking ultra small. Why? Because there are sometimes very good companies that are just very tiny. from a market cap perspective. And they do just fine. We've because they're going to be completely ignored by investors. No one's going to be looking at this stuff. So you can virtually guarantee yourself that you have a clear field of vision. All right. Mastermind Inc. The difficulty is with companies like this is guiding actual trade. So that's the counterpoint, right? Is that you can find a great business, but you can't buy any stock. It's not really helping you. Okay, so this. All right, so this is a marketing agency. And what are their actual products or services? Okay, they have some big brands on their website: Home Depot, BMW, Bayer, Verizon. Their expertise: content marketing, digital influencer, social. Okay, so sort of modern marketing channels. Let's look at the financials before we take another step. Is there anything even here to talk about? So remember, market cap for this is 4.9 million, call it $5 million. They have on the books that's what's the most recent quarter? Most recent quarter. Okay, so on the books for the most recent quarter, they have 1.2 million in cash, basically no liabilities, and they have 2.2 million in unbilled AR and a billed AR. So between cash and receivables, they have roughly $3.5 million on the books. Liabilities are around 700,000. So for this $4.9 million valuation, you have assets on the books of about 2.9. And the 9 months ended June 2023. Net income was 260,000 on $3.5 million revenue. So, see, this is. Hold on a second. Yeah, the receivables take up a lot of cash flow. What did they do last year? Yeah, so last year they did, that was 2022, they did about $700,000 worth of cash flow. The year before, 2021, remember that was September year end, so part of that's going to be in 2020. They have most of the income actually came from this gain on PPP loan forgiveness. And they had to invest that money into some receivables. basically growing the sales. Okay. So the question is, how do you get the money out? They do not pay a dividend. No one's paying attention to this company. And growth is at best not terrible. 2022, 2021. They grew 20%. And 9 months into June, relative to the previous period, they are up slightly, 3%. So they had a big recovery out of the pandemic, it looks like. And then they flatlined. Okay. Just looking back to 2020. Again, receivables kind of suck up most of the cash as they have to expand their balance sheet to grow. 2020 revenues 3.6, 2021 3.8. Okay. Let's see if we look at one more year. Just looking at sales, by the way. Just look at their sales line. Yeah, 2018, 5.2 million. The company's actually seen a decline. Okay, we're done here. That's it. So they're recovering in their sales. Good balance sheet. Seems like it's a well-run operation, but they don't pay dividend. They don't have the money to buy back stock, nor is their float really available to do so in any sort of meaningful way. So we're done. It's just too small and it's not growing fast enough. If you're small, it's okay. There's nothing wrong with buying a really tiny company, but you got to be able to then have at least some way as an investor to get your money out, right? So if you can't get your money out, then there's nothing. Doesn't matter how good it is. Okay, next one. Ticker is BABB. Inc. franchises and licenses bagel and muffin retail units under the Big Apple Bagels and My Favorite Muffins and Sweet Duet trade names. Okay. So bagel and muffin licensing. This is a business we can get. And they do pay a dividend. Again, $5 million valuation. Very small company. Let's see. They franchise bagels and muffins and cupcakes. Okay. Tiny little business. So usually when we're looking at companies this small, really want to look at two things. One, the most recent quarter. If the balance sheet has any risk in it, any risk, you're done. So if there's any other than just basic, operating stuff like accrued expense or leases or whatever, you're done. There's no need. There's no way to take it. There's no reason to take risk at this stage. So these guys actually have a very healthy balance sheet. Total liabilities. One is part of which about 400,000 of that is deferred tax and deferred franchise revenue. And yeah, so when you look at the liabilities of this company, total is 1.1 million, but about 400,000 of that 1.1 is deferred tax liability and franchise revenue, deferred franchise revenue. So they're not getting to pay that back if they keep growing. Another portion of it is a big portion, 300,000, is unexpended marketing fund contributions. So franchisees put money into a marketing fund, which the franchisor, in this case, PAB, gets to spend. So that money's not going back either. So of the 1.1 million, about 700,000 is not returnable liabilities or immediately serviceable liabilities. However, on the books, they have about $2 million in cash, 1.7, 300,000 is restricted, which is probably the marketing fund. And 1.7 is just cash. They just have cash on the books. So that that $5 million valuation, you're really paying effectively, call it 4, right? Maybe a little less. Because you got 1.7, there are some real liabilities, but you're paying about 3.5 to $4 million. So let's see what the profitability situation looks like. And they're profitable. Not growing or growing very nominally, but they are profitable, which for a bagel revenue business or a bagel franchising business is, that's good. And they paid a dividend. They're paying out dividends. So let's see. Yeah, so we're looking at so growth over 2023 year to date, $2.5 million in revenue. 4%. Or this is franchise business, so most of that's royalties. So it doesn't mean that's not system sales. (2022 over 2021) about 7% growth. Let's see what happened in 2020, because that would have been the real test. That would be the real test. In 2020, they effectively broke even. Revenue collapsed. 2019, 3.1 million. 2020, 2.4 million. So that maybe collapses it's down, 23% for a small company. That's pretty significant. But net income was essentially flat, 0. Cash flow was still positive, so they still managed to have positive cash flow in the pandemic, like in the midst of the pandemic. That's very good. And they still paid a dividend. They still paid a dividend. Amazing. All right, let's look at one more year, 2019. So these guys have paid a dividend every single year since 2018, including the pandemic. Now they cut the dividend, which is totally reasonable, but they still paid it. There's been no increase, no change in share count. So now, companies this small, obviously, the risk of things like, and this is in no way to suggest this is anyway, but there's always the risk of the size to malfeasance or just fewer eyes on it. It's easier to make up numbers, and anyways, one of the big risks of companies this size is really just you're not sure if it's actually real or not. So let's see where we can. Let's see if there's any big. Where is there's a Big Apple Bagels? Let's see what the internet says about Big Apple Bagels. Where are they located? Locations. Here we go. Locations. Thank you. Okay, they got. Holy cow. Wow. Quite a few locations actually. Around Detroit, Grand Rapids, Green Bay. Washington, San Francisco, San Diego, Florida, South Carolina. Yeah, so they have quite a few locations actually. What about my favorite muffin? My favorite muffin. Locations. God, I love the internet. And it's so great. Just gives you all the information. It's amazing. My favorite muffins. It appears there is one. Or just that says nearest you. How many locations? Okay, so my favorite muffins doesn't seem to be sweet. Do it. Big Apple's Bakery and Cafe, Sweet Duet. So it looks like they have some that are at least one that's co-located. Okay. Locations. Yeah. Okay. And what else is there on their brands? Jacob's Bagel Brothers. Bagel Bros. Oh, I guess it's their wholesale. I guess they wholesale. Okay, and Brewster's Coffee. About Brewster's Coffee. It looks like it's wholesale, but it's not clear. Just telling me I deserve a better cup. Okay, so it looks like the Big Apple Bagel is the real business. The rest of the brands are essentially meaningless, from at least what we can tell. Okay, so what is the sales, system-wide sales for the bagel business? Sometimes what we like to do is just do the name of the company, then type in the word fraud on Google and see what happens. So Big Apple Bagels fraud. That's terrible. Okay. There's a New York bagel scam. New York City bagel shop praised for denying West Coasters scooped gluten-free bagel request. Big Apple Bagelery. This is in New York Post. It's being praised for refusing a TikToker from Los Angeles his troublesome alterations of a locally beloved breakfast. For a scooped gluten-free bagel. This is funny. All right, so the brand, the brand of this guy asked for a scoop bagel. Didn't know this was a thing, but the worker, the Big Apple Bagel worker, basically told him to F off. And they yet the other New Yorkers defended the bagel server. I mean, I don't know if we approve this type of customer service, but I guess in New York it works. You can tell a customer to go to hell, and New Yorkers are actually approve of that. That's pretty funny. Wow, they're giving this guy the business. Wow, New Yorkers are ruthless. That is funny. That is funny. Okay. Okay, New York Bagel Company owner sentenced to 3.5 years. Prison for scam protective franchisees at over $2 million. Okay. Joseph Smith. So he was the owner of New York Bagel Enterprises. So the question is, who is the people? Michael Evans. Bagels. Okay, well, apparently there was a separate bagel company that actually defrauded franchisees about $2 million, but they do not appear connected to. Does not appear connected to Big Apple Bagels. But this is what you can get. You always got to check. Another thing with something like this, if it's in the same industry, it's it should be it's something you got to be careful of, because you never know. Some of the same people might be working there. Right. So that you should be able to find on. Yeah, so you'd be able to find that who's working there and is there any connection. And in general, it's just bad for the industry, right? If you have franchisees that get burned by the bagel business in the bagel franchise business, and then you're trying to sell, even if you're legitimate, you're trying to sell bagel franchises. That's just bad for you. It's just hard. It makes your job harder, right? Because people because they look up and they go, "Oh, bagel franchise scam," and they just sort of shut their brain off. They're not interested. Okay, let's see. Big Apple Bagels reviews. All right, so they get mediocre reviews. 2.5, 3, 3.5, 4, 5. Okay, so it looks like there's a wide discrepancy, very wide discrepancy in the bagel loving business. Big Apple Bagels review on YouTube. On YouTube. Something New Food Reviews. 18,000 subscribers. This was 2 years ago. I've never seen someone so enthusiastic about bagel. All right. DoorDash in Midland. 4.8 stars. 3,500 plus ratings. 4.8 stars. Okay. Well, that's good. All right. So it looks like with some of the Uber Eats 4.8. So it looks like on the. So what does that? What can we imply from that? That's interesting. So with the service, with the reviews of the direct stores, they're getting mixed reviews. But with the reviews of the services like DoorDash and Uber Eats, they're getting great reviews. So what does that tell us? That suggests that the product is good and the service needs to be improved at the store level. Okay. Okay. So so the product is good value, but they need to improve their service. Which, and arguably, even though it's only one example, when you're telling customers to go F themselves, stands to reason. Stands to reason. Oh, okay. Grubhub. Grubhub got 333 ratings, 4.5 stars. Yeah. Okay. So it looks like they have a good product. They produce a good product. It's a good bagel. I mean, it should be hard to screw up a bagel. And they pay a dividend that has been cut. So the dividend today is 4 cents, which is about a 6% yield, 5.7. But that was basically cut in half. Over the last 5 years, stock has been roughly flat. Obviously tanked in 2020, but that's every restaurant business. Okay, so tanks during recessions. So question is, how has it grown? That's the next big question. How has it grown? I got annual reports up to 2019. So let's see if we can get filings that are longer because they've been around for a while. I see here, so it looks like it's been traded since 2002. So if it's been around for 20 years, I mean, that's a really good sign. It means the business got staying power. And yet, we can only find reports back to 2019. Okay, so that's something that, so if I look at the chart, let's see if Seeking Alpha has anything on them. Last time anyone written anything about this was 2007. Microcap speculator. Yep, so 0 people looking at this. Who is their auditor? So I want to check. Who is auditing this company? Sassetti. With a company this small, you definitely want to check who the auditor is and if the auditor is legit. One Google review star, but it is a 5-star. All right. We will and payment on the BDO Alliance USA. Okay, so they're part of the BDO Alliance, which means that they should be legit. Okay. See other details about this business we can come up with. Okay, 3 wholly owned subsidiaries: BAB Systems, Operations, and Investments. Incorporated 1992. Probably established franchise Big Apple Bagels. Okay. At November 30th, 2022, the company had 68 franchise units and 4 licensed units in 20 states. There are 2 units under development. Okay. Revenues are primarily derived from ongoing royalties, yes. So they sell licensed products, My Favorite Muffin Mix, Big Apple Bagels, Cream Cheese, and Brewster's Coffee to franchisees, licensees, and approved customers. Typical B2B store is an area, okay, it ranges from 1,500 to 2,000 square feet, so it's a pretty reasonable sized store. Current store design is 1,800 square feet. Seating capacity is 20 to 30. So almost half the space is for production and baking. Sweet Duet, the company has one Sweet Duet franchise store, which offers showing various toppings. Yeah, okay, so these My Favorite Muffins, there might be more than one location. So the franchising deal requires initial franchise fee per store plus 5% of sales, 3% marketing fund. Current requires a franchise fee of $25,000 on franchisee's full production BAB store. Okay, so 25 grand up front, 10,000 veterans Jackson, 20,000 for subsequent stores. Okay. Okay. Do they report system-wide sales? 12 people at headquarters. So pretty lean. No owned real estate. Wait a minute. How much are they paying in dividends? What is the actual dividend policy? What is the actual dividend policy? December 2022, declared 2 cents, 1% quarterly, and 1 cent special to stockholders of record. Penny, 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 penny. Okay. So they declared a special dividend in December of last year. May 2013, just dividend distribution, one right for each of the income stock. Each right entitles stockholder, registered holder to purchase from the company 1,000th of a share of Series A participating preferred stock. Okay, so there's some preferred stockholder right or something. Oh. Looks like they adopted a poison pill. In general, it imposes a significant penalty on any person that acquires 15% or more of the common shares without the approval of the board. As a result, the overall effects of the rights agreement. Yeah, okay. So they've entrenched themselves. Not good, typically. Okay, so 68. They have 68 stores franchised, 4 licensed, and 2 under development. So 72 plus 2 in development, 74 total. I guess it depends on one was a replacement. System-wide revenue, 38 million in 2022, 35 million. Okay, so 35 million, 38 million, 38.2 million system-wide across 72 units, which means the average makes about $500,000 in sales. Okay, so the average store makes $500,000. Now, someone's gonna be doing terribly. Obviously, some will be doing poorly, some will be doing well. But you're saying, okay, it's a bagel shop. I mean, what are the economics in that bagel shop? So $500,000, but 50,000 a month, 40,000 a month, 50,000 a month, 45,000 a month revenue, from which they got to pay 8% on the gross. So they got 40,000 to pay rent and labor. Chances are the franchisees are buying a job, which is why it's not really growing. Okay. What was it in 2019? Okay. Okay, so system in 2019, they had 72 franchise units, 7 licensed, 79. There's 33.3 million. By 79. Okay. So they've actually increased. It was 80 in 2018, so they've decreased the unit count. But they've the remaining stores have a higher revenue per store. Hmm. So it's really good. So system-wide sales moved up 2018. was 33.8, and in 2022 was 38.2. So total increase of 13% in sales over that time period while they've reduced the amount of locations. So they should be more profitable. Year to date, they're up a little bit in terms of revenue and profits. And as we already learned, the balance sheet is pretty sound. Okay. And they've been around for a while. So let's see the dividend. Hmm. So what's their upside? As we look, they got about $1.5 million on the books, but that's probably gives you maybe a year's at best worth of runway. Maybe 2 years if business hit the skids. They've been in business for a long time. That's really good. They're paying a dividend. Also really good. There's been no increase in share count for quite a while. Or at least, actually, we can't see when the last time there was an increase in share count. So shares are stable. So any growth really just kind of accrues to the current owners. Yes. So at August 31st, 2023, there were 66 franchise units and 3 license units. Okay, so that's not really good because eventually you're shrinking yourself too much. $66 franchise units, 3 license units. This was August 31st, 2023. And at the end of 2022, what do we say? 72 total units? 68. So in the last, they have a, I guess in November. What's the year end? November year end. I don't know why they have your November year, but whatever. November year end. So last November, they had 68 locations and 4 licensed locations. Now in August, they have 66 So they lost 2 franchisees, and they lost 1 license unit. And that is down since 2018, they had 76 franchisees and 4 license units, and there's 4 that are developing. So arguably, they lost 14 units and 1 license unit. But sales, system-wide sales have grown. Okay. This is not clear. Or maybe what is clear. It simply seems to be the case that the weak units are leaving the system. Weaker franchisees are leaving the system. How much does it take to open one of these things? Do they tell you? They do not tell you. Gift card. Okay, here's what we're going to do. These guys we're going to put aside for now. There is no clear reason. So over time, it appears. So what's our assessment on this basis? They are profitable. It's good. They survive for 20 years, it looks like. That's good. They run with a pretty healthy balance sheet, also good. And they pay dividends, which is good. And the stock is relatively volatile, so you should be able to pick up stuff cheap if they're paying a penny a share or 5 cents a share with the specials. It's 7% yield, but it's also really small, and they're not growing. I mean, sales look to be growing, but unit count is shrinking. So is that good? Is that bad? With a franchise model, particularly with if you're delivering product, sometimes that's not good. You might lose economies of scale. And with something this small, it doesn't really pay to venture out too far. Okay, well, that's interesting, right? Like that didn't go anywhere, but interesting to review. We probably spent too much time on this stuff, but hey, this is for education purposes. If and most of the time we don't find stuff that most times everything's a quick pass just because we don't know what the hell the business does or whatever. For example, Execure, an early-stage biotechnology company, develops nucleic acid therapies targeting words I can't pronounce. So, done. That is the extent of the analysis. If you cannot pronounce the words used to describe the business, you do not need to look anymore. Liveware Ergogenics. So, acquiring, managing, licensing special purpose real estate properties, proof, handcrafted, organic grown cannabis. Nope. SCAS. Okay. Saker Aviation Services, SKAS, also pays a dividend. Good. Industrials, airports, and air services. I'm listening. Operates in the general aviation service segment of the operates in the aviation services segment of the general aviation industry in the United States. It serves as the operator of a downtown Manhattan heliport, a fixed base operation, and a provider of aircraft maintenance and repair and overhaul services at the Garden City, Kansas Regional Airport. The company also offers ground-based services such as fueling, aircraft storage for general aviation, and commercial aircraft, military aircraft, as well as other miscellaneous services. Formerly known as First Flight, changed name in 2009 to Saker, headquartered in New York. Huh. Okay. Okay. First red flag. This is just based on Yahoo. The CEO is the CEO, president, principal first officer, principal accounting officer, and director, and pays himself $4.5 million a year. The corporate controller, which is otherwise listed, makes 130 grand. So, and there's 12 full-time employees allegedly, according to Yahoo. So that's like you're talking a one-man band. You're talking a one-man band who pays himself very well to run a company that is $5.6 million in market cap. The CEO, according to Yahoo Finance, is paying himself the same amount, the equivalent amount of money, effectively, as the entire value of the company per year. Wow. Okay. Typically not awesome. Okay. What is where are the investor relations? Okay. SEC filings, thank you. Latest quarter and latest fiscal year. All right. What is on this company's balance sheet? Let's see what this balance sheet looks like. Wow. Cash and restricted cash, 6.6 million as of June. Total liabilities, 1 million, which means the company has 5.6 million in cash on the books. And the market cap is 5.6 million. Okay. And they're paying a dividend. Okay. We are listening. How much does it trade? About 1,000 shares a day. $5. Okay, so it trades about nothing. Extremely small. We got life insurance proceeds in 2022. Well, who died? Okay, so the revenue for 6 months was 3.7 million. Let's look at the cash flow. Amortization of stock-based compensation. Okay, that was in 2022. Fine. Someone's getting stock comp. Zero. June 2023, $700,000 provided by operations. Zero used in investing. Zero. Zero used in financing. Zero. That seems highly unlikely. Okay. We could be, okay. All of our business is conducted and reliant on the New York heliport. Interruption of business at the New York heliport restriction imposed on by the NYEDC. Ooh. Current concession agreement with the New York City expires April 30th, 2023. So maybe the reason why they're not investing anything in the business because their main contract is up for RFP and they're not getting it. At least they haven't gotten it yet. So sucking as much cash as they can. They do, however, have $5 million at a UBS account earning a yield of over 5%. It's 300 grand just in savings, interest income. So 300 grand just in income. Okay, so it looks like there's been some changes in the air tour agreement. So on February 2016, the company and the New York City Economic Development Corporation announced new measures to reduce helicopter noise and impacts across New York City. The Air Tour Agreement. Under the Air Tour Agreement, the company has not been allowed to permit its 10 operators to conduct tourist flights from the downtown Manhattan heliport on Sundays since April 1st, 2016. The company is also required to ensure that 10 operators can reduce the total allowable number of tourist flights from 2015 levels by 20% beginning June 21st, 2016, and by 40% beginning October 1st, 2016, and by 50% beginning okay. Since 2016, the company is required to provide monthly written reports to New York City NYCD EDC to the number of tourist flights conducted out of the downtown Manhattan since compared to 2015 levels, as well as information on the tour flights over land or strays from agreed upon routes. The Air Tour Agreement also extended the concession for 30 months, resulting in a new expiration of April 30th, 2021. Gave the City of New York 2 years, 1 year extension options. The term of the concession agreement was subsequently extended by the New York City 2023. Expired on that date. Company crew. So they have a Empire Aviation's a management company. Okay, on April 28th, 2023. Company entered a temporary use authorization agreement effective as of May 1st, 2023 with the City of New York. The use of the agreement has a 1-year term. The company has been granted exclusive right to operate as a fixed base operator for the downtown Manhattan heliport, collecting all revenue derived from the. So it's like a toll operator, but it requires this contract with the city. In addition to terminations for an event of default, the use agreement may be terminated in time by the commissioner of the DBS, Department of Small Business Services, DSBS, or suspended at any time by NYCD EDC. The company is required to use under the agreement to remit monthly administration fee to the NYCDC of amount of $5,000, 60 grand a year. Okay. During 6 months, then the company incurred 10,000 admin fees, which are recorded cost of revenue. On July 13, 2020, the DSBS was granted approval by the Franchise Concession Review Committee to enter into an interim concession agreement, the new agreement, with the company in order to provide continued operation of the downtown Manhattan heliport for 1 6-month term, with 2 6-month term options to renew at the discretion of DSBS. The new agreement is intended to govern the company's operation of the downtown Manhattan heliport, while the new RFP is rated by NYCDC for release. The company is currently working on clarifying the business and economic relationship between the parties, including additional fees paid by the company's downtown operation. Expects the new agreement will be finalized and entered into October 2023. We expect the new use agreement will expire at the. Wow. Okay. Seeking Alpha. Cedar Creek. Interesting. Okay. So did they get the new agreement? Or in October? Air Garden City, one of our wholly owned subsidiaries, entered an FBO transfer agreement with Crosby Flying Services, pursuant to which GCK agreed to sell the Crosby substantially all of its assets and none of its liabilities, and to a 7-year non-compete, whereby we include fixed supplying aviation fuels and lubricants or the supply of for $1.6 million. As disclosed in the current report filed with the SEC November 2nd, 2022, the transaction completed by the transfer agreement closed and became subject to non-compete for an aggregate purchase price of $1.5 million. Crosby paid purchase price on closing date less $160,000, which is paid in cash upon the first anniversary. I see. Okay, so they've already got the cash. It wasn't a big business though. I mean, lots of revenue, but not a lot of profit, not income. Okay, allegedly, they will have a new agreement. In October. It's October, and there's no announcement. Expects the new agreement to be finalized and entered into in October 2023. Company expects that the use agreement will expire upon the effective start date of the new agreement. Okay. Okay, so really their entire business, they used to have this business of like fueling ground services and aircraft for storage and at the Garden City, Kansas airport, but it looks like that's what they sold last year, 2022. So their entire business is based on this heliport, which they currently, it's not clear if they're going to have the contract to actually operate anymore. Okay, so they got $500,000 from the CEO dying in 2022 June. Maybe that's the reason for the RFP. This guy had the relationship and he's dead, unfortunately. And that's when it all started to go wrong. That's why they're not getting the RFP back. So who is running the company? Interestingly, they have $5.6 million again in the bank, which is the exact same amount as the market cap, and no significant liabilities. Okay, so it makes sense why they have zero investment in the business. They don't know if they're going to have a business in very much longer. So in July, they got this. So they got 6 months extension. So what would be the correct approach here? Now the problem is, if you were to buy in and they lose the contract, doesn't mean that the company's just going to be like they're going to just give back the money to investors. That's not necessarily true. They might try to do something else strategically, which is a bigger risk. So you get 1 6 month operation, 2 6 months. Okay, so I guess is it even worth taking a risk? Doesn't feel that way. Like why would you gamble on the contract? What's the upside? The upside is not that significant. You're talking 20% on something marginal, right? Like you're talking 20% on cash, basically. Because what is the actual? Yeah, they got 6 million, 6.6 million, 6.7, call it, and $1 million in liabilities, right? So you're talking 5.6. What else they got? You know, equipment, property, plant, equipment is nominal. Maybe they can sell for whatever something, but it's not what you're going. So they got non-compete receivable. So let's see. Let's see what the actual cash is. 6,667. Let's assume they collect the receivables. And assume they get this non-compete paid minus the million. Yeah, so they got about 6 million bucks, right, on the books. Stock is market cap is 5.6, right? 5.6 million. Yeah, so 7% margin of safety just on a cash basis, right? So 7%. So in the meantime, though, so in the 3 months ended June, they got 690,000 in net income. That was 3 months. For the 6 months ended June, its net income from continuing operations is 591,000. So obviously there's some seasonality to the business. So what was Q1? All right, what was the Q1? Right, because you're basically your case. So you're currently at a discount to cash effectively, but the company's you're still allowed to operate. So the government's giving you a license to operate to heliport, which you've been doing. So Q1. Okay, so there's some seasonality. Q1, 1.32 million in revenue, and they lost 100 grand on that amount. I mean, cash wise, they made cash, so that's fine. Q2 revenue is 2.4 million in the quarter. So, like okay, so let's look at historical. Let's look at what are historically Q3. What does Q3 look like historically? So Q3 2022, 2.6 million in revenue. 2022. 2021 was a disaster. 680,000. What are the margins though? The margins presumably are right. It's just they're a toll bridge operator operating this helipad. Yeah, margins are good. Yeah, margins are good. So even if revenue is terrible, like it was in September 2021, 680,000, they got earnings of 200,000 on the 680, and on the 2.6 million, they still had earnings of 200,000. So arguably, but there was some discontinuing operations issues though in there. And they really liquidated the balance sheet then too. I guess the point is, last September, they still made money. Okay, so obviously the summer months are better. It's helicopter tourism business, so June is a better business. And what was the full year 2022? Full year 2022, 7.5 million. Okay, so it looks like Q4 and Q1 are the worst quarters from a revenue standpoint. Q2, Q3, summer months are the best for helicopter rides. Okay. Which means that they get 6 months of operations. Okay, so what's the bet here? You're buying a discounted cash. They're getting money from operating the part. If they don't close the deal, then Your risk is management does something stupid with the cash. That's the risk. And there's not enough liquidity to protect yourself. So that if you see management start to do something stupid, you can't get out. Okay. So what happens then? Okay. The dividend they're not going to pay, so they're going to preserve cash. Who is the current CEO? Who is the current CEO? So who owns the most? Mark Chodak. Directors, Samuel Goldstein. Mr. Goldstein is the company's sole executive officer. Okay. So he's the sole executive officer. Mr. Rab used to be the company's principal financial officer in July 2020. Okay, so it's not good when you lose your CFO. I mean, small companies, so CFOs like. So you got one guy control everything, which is not awesome. Typically, it's not awesome. It's just less checks and balances. William Wachtel and Mark Chodak control the business. Who are these guys? And then Ravi, those are the directors. You have Ronald Heller, Ravi Desai. Oh, it says William. Okay, who's William B. Wachtel? William B. Wachtel. All it says is the chairman of the board of Sacred Refuge Services. Chairman of Fernhay Solutions, Columbia Law School. Chairman of Billy Bay Ferry Company, your ferry business. Okay. Looks like he's a lawyer in New York City. Looks like he is a lawyer in New York City. FEC review complaint against William Wachtel. New York City lawyer accused by ex-employees setting up straw donations for Andrew Yang, drawing attention from feds. Oh, for goodness sakes. No, I don't want to subscribe. Okay, that's not good. Sam Goldstein. Who's Mark Chodak? ACM Value Opportunities Fund. Is a partner in this ACM Value Opportunities Fund. Okay, I think we've seen enough. We have seen enough. And we are going to move on from Saker. Yeah, so the conclusion is simple. They have this outstanding contract, which they need to resolve. In the meantime, they're going to earn revenue from it, so that's good. And they're investing basically, or at least last quarter, they invested zero in the business. So they're putting no money back in. Everything's going on the books, on the balance sheet. That's good. The downside is, what do you as an investor get out of this? You're taking a marginal discount to cash, right? You're taking a marginal discount to cash. It was trading. Stock was trading in around $4 in June, so might have been an opportunity there. But and in 2022 it's at $3. So stock's obviously gone up. In the meantime, so they're going to collect cash. If they continue to invest nothing in the business, or at least keep it very marginal, then all that cash is going to get pushed to the books, which they'll actually earn some interest income on, which will be a sizable amount, right? Because they have about $6 million on the books at 5 points, 3%. Now, it's not ideal, but better than them blowing it. So they're going to invest. They're going to take the money and then invest it. The problem now, that's ordinarily would be fine. So far, I also get the real calculus is what happened. Can you have a no lose situation? Can you have a no lose situation around the contract? Because they got 2 6-month extensions, which are entirely at the behest of the city of New York. Can you have a no lose situation? If they don't get the contract, then you're sitting on a discount to cash. The risk is, what do they do with the cash? Do they try to get into some other business, or they distribute to investors? If they don't distribute into investors, and you look at the board and it's like, well, do they buy out the main? How do you as a small time investor? Because the liquidity is not there, or it's at least you'll have to take a haircut to the price. So if they don't get the contract, then your risk is really, what do they do with the cash post? If they do get the contract, then the risk you're taking is the same risk as you would otherwise be taking, which is, what happens, how many tourists are taking helicopter rides in New York City, which seems like a reasonable prospect. They might not, it might not kill it, but you're still sitting on discounted cash, and you'll get some income out of that. All in all, it seems like it's a fair addition. Something like this would be a fair addition in like a quasi net, or like some, it's a decent bet. It's not great, but it's decent. If you knew the players involved, then you can get better sense of what they would do with the cash if the company were to go, if they lost the contract with the city, then you have a better deal. Then you go ahead. The other thing you got to be careful of is if they do make a contract and the contract is on terms that are not really economic, then the prospective cash flows is actually worse, and you get trapped in this business that you actually don't want to do because you're all set up, and so it's hard to walk away from any sunk costs or infrastructure, but you just don't want to do that. So those are the kind of the three main risks. Um, Without looking any further, it feels like this. If it's a one heliport, it's like a toll bridge, or you're not going to have competing operators. Chances are. So assuming you win the RFP, then either it's on economic terms or non-economic terms. If it's on non-economic terms, that's also bad. Chances are it will be at least economical. The city wants its cut, but too bad. And then you're in this toll bridge, and then you're entirely dependent upon the propensity for tourists in New York City to want to take helicopter rides around New York City, which seems reasonable as a business. And they paid dividends in the past, and they bought some stock back, but from who? Not clear. Yeah, so they paid dividends. Last time they paid dividends was in 2020. So once you get through all that, right? Assume they get whether they get the contract or not. If they don't get the contract, whether with the cash, they get the contract. Is it economic? Assuming it's economic, then you're dealing with the fact that, will there be a decline in tourism? If not, then you're making money. Great. Then what happens to the cash, right? Do you get a dividend? If they reinstitute the dividend, you'll be making money at a discount to book. Maybe they do a special, right? They might even do a special dividend because they're holding too much cash. So, entirely, yeah. So the real lose scenarios are they don't get the contract and they do something stupid with the cash. That's a bad scenario. And the chances are that, or at least we have not seen management teams that are like super willing to just give up. They'll want to do something, keep their job, etc. Now on the board are at least one investor who has a fund, who has a value opportunities fund. So, and that guy owns quite a bit. I think it was like 11%. Where's the number? He seemed to own quite a bit. So if you have the board members who are aligned with shareholders, and at least one of them appears to be aligned with shareholders, or a couple of them appear aligned with shareholders, then you might be able to have a situation where they go, okay, they'll do something that's actually shareholder friendly, but entirely out of control and very hard to predict. So we think that's it. We think that's it. Last person, Ronald Heller, number 11. Keller Capital Partners. Yeah, so there's a couple of investors on the board. Yeah, okay. So we're going to pass on Saker for now. We're going to watch it. It'll be interesting to see what actually happens. And that's it. No point in starting anything new otherwise. So thanks everyone for tuning in, and we'll see you next time.